to freedom.
Woohoo!
Do you know what April 15th is, Marcy?
It's the day you asked me to marry you.
Okay, but to everybody else.
It's tax day in the United States of America.
It's also Abby Price's half birthday.
Oh, okay.
For some reason, that always stuck in my head. Because I mentioned something, she goes, well, it's my half birthday. And I was like, congratulations.
So which will we be covering in today's video?
So, everybody, I'm Mark McKay. Welcome to Sage Smart Solutions.
I'm Marcy McKay.
Please join us, like and subscribe. Join us weekly as we talk about new to you ways to protect your assets, take Uncle Sam out of your retirement, and retire tax-free. All right, what am I talking about? Freedom. I'm really having trouble not breaking into George Michael song right now. But,
Too bad we don't have a jukebox that we're going to explode.
just ripping a leather jacket. Okay, so April 15th, I realize it wasn't this year, but April 15th
Right.
is what people consider tax day.
Yes.
And I was actually on a Zoom call last week, and he was fishing for that. He was like, "What are we right now?" But it wasn't actual April 15th, and I got a little smart, and I thought, well, Tax Freedom Day, and I wasn't 100% sure. But do you know what Tax Freedom Day is?
I do not know.
I think this year it's April 16th, and basically that means that up until this point, everything you did. Have you watched the news in the past 2 years?
Very
Those
upsetting.
are the guys that until this weekend you were working for. When I say the guys, politicians, I'm talking about Washington, and the revolving door they've got with Wall Street. But for the average American, up until April 16th, all of that money went to taxes.
Okay.
So from now on, from here on, the rest of the year, you can work for you. But
So April 16th through December 31st.
yeah. Up until that point, you're just working for up until April 16th ish. Depending on it's obviously different for everyone. Not
Right.
everybody pays taxes. A lot of our clients don't. But one thing it made me think of is, do you know what a required minimum distribution is? Kinda. And it's a phrase that in the financial services industry we're comfortable working with. I've done 72T distributions. I've helped people donate required minimum distributions. But it dawned on me is that, the average 35-year-old may not have given a lot of thought to required minimum distributions. But what we're talking about...
A lot of 55 and 65-year-olds haven't either.
Yeah, it's one of those things you don't think about until the government tells you have to do what they say you have to do.
Right.
And you willingly went into that scenario by listening to people like Dave Ramsey and your Merrill Lynch and Howe broker that always pitched defer taxes. And so now
So rather than paying your taxes, kick the can down the road so you can earn more money now.
And there's philosophy to back it up. They'll say, well, your peak earning years are here.
Right, but people like that say it so they can be charging you more.
Well, but that philosophy is that you're going to be broke during retirement. Do you think taxes are really going to go down so much in a country with a $32 trillion debt, a $1 trillion deficit?
Yeah.
Taxes are going to go up. So required minimum distributions. You listen to your guy. You listen to Dave Ramsey, and they said, max out your 401k, your employer match. You want to, which I can beat the employer match, but I understand, do it. I think it's a good savings tool, and it teaches you to put. But the problem is that they're telling you to go put it into assets that go down. But okay, required minimum distributions. You've saved in your IRA, your 401k. You roll it into an IRA at retirement. You haven't touched it. You've got your Social Security and your other assets. And one of the reasons you didn't want to touch your IRA or your 401k is because when you take distributions from it, it creates taxes. When you're taking Social Security and you have other taxable income, you run into the risk of making your Social Security taxable. So you want to talk about really...
So that's scary. Say that again slower.
If you have a certain amount of income in retirement, it will make your Social Security. So all this money that you put away year after year after year, they're going to tell you that you got to take a third of it and give it back to them. So
it's sort of like you're cutting off your nose to spite your
kind
face.
of, well, but they're making you do
You're
it.
inadvertently hurting yourself.
So
you thought you were doing something good.
So you've got all these assets in these tax deferred buckets, and the IRS, you took a tax deduction, it grew tax deferred. The IRS is just chomping at the bit. You know, these guys in Washington, it's like cocaine. They see it there, and they think, okay, well, this was just a retirement savings vehicle, not a tax avoidance vehicle. So you have to.
They always change the rules depending on what works best for them.
Well, but they also played on human greed. They know
Right.
that you want to save money in 2020, not knowing that you're going to make less and have less control and fewer options in 2042.
Right.
Didn't mean to stick my hand in front of your face there. So they'll say, whatever's in your IRA at, and I think it's 72 now, but it used to be 70 and a half, which is another government thing because you had to, you'd have to go get
70 and a half.
a year, an engineer and an accountant to see whether you had to pay taxes, and you have until the end of the next year. The tax system is broken, people.
Right.
We helped our son. He got $1,000 fellowship last year, and it took us.
No, it was $3,000.
Last year he just got $1,000.
Oh,
The
okay.
$3,000 was year before. Anyway, the IRS is broken. Okay, required minimum distributions. You've got this big bucket of money. The IRS sees it. It's their cocaine. They want it. The politicians need it. They got to fly back and forth 6-7 times a month.
In their big fancy jets that we're paying for.
Or, their golf buddies, big fancy jets that we're paying for. Anyway, so they will say you are required to take distributions out of these accounts. If you've got a 403B that you contributed to, a 401k, your traditional IRA, you've got $1 million. They'll say, okay, we're going to take a table and calculate your life expectancy. So if your life expectancy is 87 when you're 72, they'll say you have to take out 1/15. I'm not giving tax advice. It's just general knowledge.
Well, and you're giving examples.
But I just want to make people understand that if you're not aware of required minimum distributions, think about that. Yeah, go get your company match, your employer match for your 401k, but then plan to minimize the negative effects that the
money
taxes.
you have to pay Uncle Sam.
So you're 72. You don't really want this money, but the government wants you to pay taxes on it. Oh, wait, what? Taxes are 57% now?
Ugh.
Well, you sure don't want to take it out then.
Right.
Oh, but they tell you have to. The guys who also raise taxes raise the requirement. They actually took the required minimum distributions away in 2020, I think, because of the pandemic.
So what can people do to protect their money?
Plan. To reduce your taxes in this year, there are some strategies. They made it more complicated, but there are some gifting strategies where, say you've got a highly appreciated asset, which, with what the real estate market has done and the stock market, you might be in that situation, but you don't want to pay the taxes. You can donate that asset to a properly structured charity and get a nice tax deduction. You're like, okay, well, that's great, but I don't have that nice asset anymore. And, I thought my kids might benefit from it. Okay. Well, you can take you can do what's known as a split interest. So we have $1 million piece of land that was worth $1,000 when we inherited. What do we do with it? We donate it to a charity, but we say, you know what? We want $20,000 a year for the next 10 years coming back as income. We then take that, we apply the Sage Flex method to it, and we replace that asset. We get it working. So now we have a $2 million asset. We've got the tax deduction. It's
a win-win-win.
But you have to structure it correctly, and you need to plan ahead. I get people every late February. They're like, what can we do? I'm like, well, for this year, we can do this. For the thing that you knew was going to happen for 2021, sorry.
Well,
anyway.
but we've seen it over and over, and we've been guilty of it too. Money can be a stressful thing. You don't want to deal with it, so you just kind of keep not dealing with it.
Definitely human nature.
Yeah.
If I were to tell you, I can put an extra $700 in your bank account today, but it's going to mean $700 a month less tax rate. I don't know this math, but I've seen it work this way. But if that's going to mean that you have $700 a month less a month in retirement, is it a smart move to do that today, to take that immediate gratification? Wall Street knows you want that immediate gratification.
Right.
Washington knows you want that immediate gratification. They're going to tempt you and tease you with saying, wait, defer taxes until you're retired, because when you're retired, you won't have all the income. Well, that's a horrifying thought. Let's set it up so you do have income. Now, we can set it up so that income is tax-free.
Right.
And then that gives you more options to go and pull money out of your tax-deferred accounts, because
life happens.
Well, and it might not, if the majority of our assets are coming out tax-free, then we can go take $50,000 out of this account, our IRA, without bumping us up into the next tax bracket. But if you're in the 24% tax bracket, you definitely need to take this time and look at your situation. Should you do a Roth conversion? You definitely should set up a tax-free income strategy to provide you with tax-free income without stock market risk in your retirement.
Right. It just gives you more bang for your buck.
So let us help you take Uncle Sam out of your retirement account, because if the majority of your assets are in a brokerage account and it says Charles Schwab for the benefit of John Smith traditional IRA, it should say Charles Schwab for the benefit of John Smith and Uncle Sam traditional IRA, because he's going to get 40% of it.
Right.
Let's plan so that doesn't happen. Reach out, like and subscribe to our channel. Bing. Hit the link down there. Let's set up a 30-minute Calendly. We'll chat. I will visit with you.
And find out if
you
you're
want
a
to
good
talk
match.
fishing, we'll talk fishing and let it go at that. I won't talk more than 30 minutes. But if you want to talk about ways to protect your assets and simple moves you can do now to structure your retirement, to not let the idiots in Washington blow it for you.
I love
Set
how
up the appointment now.
Smart you are and how passionate you are about helping people. It makes me happy.
Good looking. I love you too. Thanks for joining us. Please let us know if you have topics. Maybe you'd like us to do a deeper dive on required minimum distributions, RMDs. There are other ways to structure that. You can actually donate those. Or you can actually have those go directly to fund a leveraged whole life, a cash value policy. But I'd be too old. Let us show you how it works.
And I love the little voices that you do. Bye.
Thank you.